Welcome to The Man from Macro, where we look at some of the big themes in today's global markets. At various points over the last couple of weeks, we've seen the S&P 500, gold and Bitcoin make new all-time highs on a closing basis. The US equity market has been pretending that it's bulletproof, turning in one of the most consistent multi-week performances in its history. It has risen for something like 16 of the last 18 weeks, spurred on primarily by a handful of mega-cap tech names. Therefore, all eyes have been on the US for a potential shift in the stance of policymakers. So far, the market is holding on to its call for rate cuts in 2024, with around 3 still priced into the Fed funds curve between now and December. Policymakers have the opportunity to adjust their forecasts at the next FOMC on the 20th of March. Very few people are expecting a dramatic change. But are we looking in the wrong place for a disruptive catalyst? An increasing number of commentators are now thinking about Japan's potential to undermine markets. But why should that be when Japan's headline equity index, the Nikkei 225, is only just breaking back above the all-time highs set at the end of 1989? It's mainly due to a belief that the Bank of Japan could start a belated liftoff from an interest rate policy that has remained unchanged at marginally below zero since 2016. And prior to that, it hovered just above zero for a further 7 years. So what, you might say? Aren't these tiny step changes? Well, it matters because Japan is a massive creditor nation with an estimated $3 trillion worth of overseas investments. This has been a near constant outflow from Japan's shores, chasing better income and investment opportunities in overseas markets. It's a result of the years in which interest rates and yields in Japan have been dramatically lower than those available elsewhere. Since the peak of Japan's stock and property bubble in the early 1990s, US rates have been consistently above those in Japan. And whilst the cost of hedging currency exposure has sometimes handicapped the foreign returns available to Japan's domestic investors, it's generally been one-way traffic of outflows. These flows could easily reverse on the back of marginal changes in policy and sentiment. If the Bank of Japan were now to indicate that they were abandoning their zero interest rate policy and also giving up on their yield curve control, then the marginal domestic investor may become inclined to keep their money onshore or even repatriate it from overseas. So far, most of the interest in the domestic equity market has been due to an uptick in foreign investment. But with the index breaking their all-time highs, there is now an alternative to the US market. Furthermore, if retail investors thought that a policy reversal could lead to a prolonged tailwind to yen strength, then they may want to repatriate foreign assets before a stronger yen erodes their overseas performance. If the yen strengthened from 150 to 135 versus the dollar, then all things being equal, they would lose performance on any unhedged US assets. And we do have form with higher Japanese rates as a precursor to a recession or stock market top. Obviously, the rise in Japanese rates was often tracking rises in US rates, and the US has dominated the global business cycle. But in 1991, Japan's rates rose into the US recession long after the US had started cutting. In 2000, the Bank of Japan attempted to raise rates just as the Federal Reserve hiking cycle was ending. The BOJ hike coincided with the market peak, and in June 2006, they started raising rates just as the US rates peaked. The equity rally still had some legs, but the beginning of the BOJ cycle was much closer to the end of the US equity bull market. Clearly, all of this is a grotesque oversimplification of a complex set of international flows. Very few expect the Bank of Japan to flick the switch in their March meeting, but many expect them to shift in April. Therefore, the BOJ and the Japanese yen should be worthy of all international investors' attention. A small change in Japan could lead to a directional change in the deepest recesses of global financial markets, because Japanese fund flows are a major driver of international asset performance. That said, please remember, none of this is investment advice. These are just observations for educational purposes only. And everyone should be aware of their own investment objectives and risk profiles. But thanks for watching.